In this video, we'll learn how to trade crypto futures on Bybit. I'll show you how to navigate this screen, how to enter orders, and then how to use the unified trading account to make sure everything is set up perfectly for you. Then towards the end of this video, I'll go over some professional trading strategies so you can use them to manage your risk in the way that you want. I'll leave timestamps for all of that down in the description below. If you want to trade crypto futures on Bybit, you need to get some assets into your unified trading account. If you don't have an account with Bybit yet, I'll leave a beginner's guide down in the description on how to get money in and out of the platform and get yourself set up. I'll also leave a link down there at the top. You can get an up to $30,000 deposit bonus. If you make a deposit and trade, they'll give you that in your futures trading account. It's a great bonus, so you can check the link for the details there. But if you do have assets in your account, you've set up an account, what we have to do is get them into the unified trading here. So you can very easily do that by transferring if you have some assets in your funding account. So transfer, and then from one account to the other. So from funding or wherever it is, you want to get it into your unified trading account. That's a free internal transfer, so you can just transfer that over. Now, what do people trade with on futures? Usually they will trade with stable coins, because when we're trading futures, we are not trading crypto, we are just trading the prices of crypto. And the way that we trade and open positions is by having collateral there to fund any potential losses. That collateral can be many different things. It can be a stable coin or it can be a crypto collateral. Bybit let you use pretty much any type of collateral as long as it's one of the larger coins. Most people will use stable coins because it has a stable value versus the other cryptos that they're trading, but there are many different strategies which I'll go through in this video. So we get some assets in our unified trading account, and once they're there, all the value of those can be used to fund our positions, but we can choose exactly what funds what positions. So I'll go through that in a second. Quickly before trading though, here are the trading fees. You can screenshot this. These are for futures. Extremely competitive, amongst the lowest in the industry, and you can screenshot the details if you want to go up to the VIP levels, which is higher trading volumes or putting a chunk of cash on the account. Bybit offer two types of crypto futures contracts on their platform. One is perpetual futures and one is expiry date futures. Now, most people in crypto will trade perpetual futures. That is, there is no expiry date, so you can open your position, and as long as you can fund it, you can keep it open, and then you choose when to close it. There are expiry date futures as well, with an expiry date in the future. To show you the difference here, what you can see is that this is the current perpetual futures contract, trading more or less the same price as the current spot price. So right here. But if we go to derivatives and we can go over to futures here, and then you can see the expiry dates. So these have different expiry dates that you can trade. If you go into a position here, then at some point in the future, on the expiry date, your trade will automatically close and the balance be put back into your account. If we click on the expiry date future, so that's around 8-9 months away from making this video, you can see the price is different. So the price right here is around a few $1,000s more expensive than the current price. So the market is currently pricing in that in the future, Bitcoin will be higher than it is now. And of course, you can take a position on that. If you disagree with the market, you can go either long or short, taking positions, betting that the price will go up or go down, and we'll get onto that in a second. But the two different types of futures are perpetual and expiry date. Most people trade perpetual futures. Bybit do give leverage when trading futures. You don't have to use it, but that means that if you put $1,000 on the platform, they can give you $5,000, $7,000, $10,000 to trade with, and your $1,000 is there simply to fund any potential losses. We'll go over those calculations in a second, but I would suggest looking at the margin data. This is if you're borrowing money from the exchange to take these positions, you do obviously have to pay an interest there. This changes depending on your VIP level, but you can screenshot this as well. This is going to change over time dependent on supply and demand. So something to keep in mind when you're opening positions, especially for long times, is that you may have to pay, or you will have to pay this interest rate, and it may affect the position, especially if you're paying higher fees. But you can see for the larger cryptos, the borrowing rate is fairly low. Bybit also have a calculation on how much money you have to put down to trade futures. And so this calculation right here is how they do it. They take your position size essentially, and then how much leverage that you want to use. And that calculates how much initial margin that you need, which is how much money you need to put down to fund the position. And then on top of that, they have this maintenance margin, which is, as you can see here, this calculation. This is to prevent any bad losses on the platform. So you shouldn't go into bad debts because the amount of money that you put down to fund positions should essentially be enough to liquidate you if you're making losses. So you have your initial margin that you have to put down. And essentially, the more margin that you're using, the more leverage that you're using, the less initial margin that you put down. I mean, that's the whole point, right? If you're putting less down to fund the trade, then you're increasing your leverage on top of what you've put down. And then the maintenance margin is just a buffer for them to be able to liquidate your position if you are in a loss. And so this is an example of how they calculate that. So you can use that calculation for your trades, but it shows you in the trading system anyway. Now let's get to the type of margin mode that we're using with Bybit. So Bybit use a unified trading account. And all that means is that there are many different ways we can use to margin our positions. So what collateral are we using and how can we use it? So the unified trading account is one account. And if you have assets in there, they can be used to fund positions in many different ways. So if we click unified trading account here, go to settings, and then it's this one, margin. So we're going to click isolated margin. That brings up these three different accounts. So for most people, if you're using dollars or stable coins to margin your positions, which most people do for the most part, then isolated margin is going to isolate each of your positions separately. So if you have a Bitcoin position, you have to fund that with a stable coin. And so you do that. And then if you have an Ethereum or a Solana or any other position, you use dollars to fund that position and they are separate from each other. So if the Solana position gets wrecked, lose money in that, the other two positions are still fine. So it doesn't use that margin, and the collateral that you have there across those positions. So as you can see, this supports USDT perps, right? So stablecoin perps, which is the crypto versus the stablecoin, that pair, that trading pair. And you can use these different modes, which we'll get onto in a second. And you can see here, isolated margin will apply to all USDT and C perpetual futures. This is what most people use. It's very simple. Cross margin mode. This goes a little bit further where, as you can see here, you can use different types of collateral to fund your trades. So it enables trading of derivatives with USD value of multi-asset collateral. So for example, you can put Bitcoin and Ethereum into your unified trading account, and the dollar value of that, which obviously fluctuates, but the dollar value of that is used to fund positions. And this is slightly more advanced because you can use different types of strategy where you are hedging your risk. So if you have Ethereum and you have that and you own it in your spot account, but you think the price is going to go down, well, you can use the ETH as collateral to fund a short position on ETH. And that's more of a hedged position rather than just, I'm using dollars to speculate on the price of crypto. So it's a little bit more advanced, but it enables you to do that. Now with portfolio margin, I would say this is definitely more for professionals who are managing lots of different positions. Maybe they've got big spot bags as well. So they have a lot of assets just in the spot account, and they have some options positions, and they are hedging lots of different trades. I would say for the most part, normal users don't really have any need for the portfolio margin feature using all of your collateral there. I would just clip it to isolated or cross margin in what you want to do. And that's not going to kind of wreck your account. You want to just make sure that your futures positions are kind of cordoned off from the rest of your account. So either you want to use dollars to speculate on prices and go long or short, isolated margin is great. And if you want to hedge positions, you can use cross margin. So what you can do is just click the settings here and you can switch that over. So now we're in cross margin, right? So if you have positions that are currently open in the market, then you can't switch the margin modes. So you have to close your positions first before you switch. So make this decision before you've got any positions running. From the same setting screen, we can choose the position modes that we trade with, one-way mode or hedge mode. That's right here. So one-way mode is probably better for beginners. This only lets you open a certain position in a crypto at once. So let's say you open one position and you're long Bitcoin. You're long $10,000 of Bitcoin. But now you're in a profit, but now you think the price is going to fall. So what do you want to do? You want to sell some Bitcoin. You want to go short. Well, you can't go short Bitcoin because you have a long position. So what you have to do is close that long position. So maybe you close $5,000 of it. and now you're still long $5,000. If you want to go short, you have to close the rest of that trade down to zero, and then you can open a short trade. So you can't open long and short at the same time. You're either long, close, and then open another position. With hedge mode, you can open longs and shorts separately at the same time in the same asset. This is going to be better for maybe more advanced traders, because with hedge mode, you can have two completely different trades running at the same time. So maybe you have one trade where you're, delta neutral, and that trade is working for you. I'll explain what that is later if you don't know. But then, you have that trade and you don't want to change it, but then you just have a completely separate trade idea that's completely different, and you need to open an opposite trade in that same asset. And of course, with one-way mode, you can't do that. So with hedge mode, you can open long and short at the same time. And if you have multiple different strategies running at the same time, then hedge mode is for you. So hedge mode may be the better option to go with, but if you are a beginner and you're just looking to start out, maybe one-way mode is going to help you out. Now we'll look at some specifics of the crypto futures contracts that we're actually trading on Bybit. So with crypto futures, we have three different prices. We have the market price, which is trading on the system that we're using, which is this one. This is the price at which buyers and sellers are trading on this system. And as we know with futures, futures are a synthetic contract, and so they're not the underlying crypto. And so the price may be different than the underlying crypto. It's based on supply and demand on this system. And so that's what we're trading here. However, that price can get away from the actual market price around the world, right? So that the way that crypto exchanges try and work with this is that they have an index price and a mark price as well. The index price is an index of the leading crypto exchanges like Binance, Bybit, OKX, Coinbase, and that will just basically have a price feed from all of those exchanges. And so that index price is what the crypto futures are trading on all of those exchanges. So that hopefully gives us an accurate representation of what the actual market is trading, just in case anything goes wrong on an individual system, because errors can occur, you get these big spikes, and of course, we don't want to trade that, and we don't want our positions to trade that, because that may be an error. So what we have is the index price, which hopefully gives us an accurate representation. We also have the mark price, which is Bybit's official contract settlement price. And again, that can be different from the actual market price down here. The reason is there may be errors sometimes. You get these big spikes, and that's obviously not correct. It's an error. And so what happens is we can actually place our trades and our liquidations and all our liquidation levels around the mark price. And that gives us some protection against errors. And so what happens is you may have a stop loss level or something like that where you trade at, which is a specific price. But what that actually is the mark price. And so the mark price is the thing that we actually trade our contracts against, not the market price here. The mark price has to be at that level. The market price can be a little bit different. You can see this is 42,755. The mark price is 42,760. As you can see here, just changing. So the mark price is what Bybit uses to actually execute the contracts and any liquidation levels that we might have. There is also a funding rate within crypto futures. Because crypto futures are a synthetic contract and they're not actually the underlying crypto, the price can very easily get away from the underlying spot price. And because it's a futures, perpetual futures contract, it can get miles away depending on supply and demand. And in fact, the crypto price does get away from the spot price a lot. So the way that most crypto exchanges try and keep the crypto futures price in line with the spot price is through the funding rate. This is essentially an incentive to the market to try and bring it in line with the spot price. So if the crypto futures price is above the spot price, that's not good, because people are buying up the crypto futures, pushing the price up, and it's not accurate in relation to the spot price. So what happens is the funding rate, if it's positive, that means there are more longs than shorts, and the price is too high in relation to the spot price. And so if you're long, if you're going with the market and you're pushing the price up, you have to pay this funding rate to short sellers. It is a disincentive for you, and it is an incentive for short sellers to come in and push the price lower back to what the spot price, what it should be in relation to the spot price. So if you're long and this is positive, you pay this out to short sellers. If the opposite is true and the crypto futures price is below the spot price, then this will be negative, meaning that the price is too low and short sellers have to pay this funding to buyers going long. So you either pay or receive this funding rate. It depends on what the rate is and if it's positive or negative. You can see it's slightly positive right now, and it is exchanged between longs and shorts every 8 hours. So this is something you have to factor in. Most of the time it's not a big deal, especially in the larger assets. But what you can do is go to derivatives trading data and then look at the actual funding rates. And you can see exactly what the funding rates are for the assets, right? So you have BTC, ETH. You can see that you can work this out. So every 8 hours, you can work this out as an annualized figure. It usually comes in the region of about 5 to 10% if you hold the position open for a year. But this is something you either pay or receive depending where it is. So something to keep in mind when you have open positions. Now let's look at using leverage with crypto futures. So with leverage, we can choose what assets we're using to leverage our position and fund our positions. What collateral are we using? So again, you can use a stable coin, which is a stable value. And so that's easier, but you can also use crypto assets. Crypto assets are riskier because they are risk assets that go up and down in value, and your position is going up and down in value as well. So potentially you can use Bitcoin to long Bitcoin. And that's riskier because if your position loses, not only is your position down, but your collateral is going down as well. And so, your liquidation price moves up if you're going long. So that's why most people use dollars to fund positions, because it's a stable value versus the non-stable position. So you can choose that as you wish. And then the amount of leverage that you want to use is right here. 1x leverage is no leverage at all. So you don't have to use leverage. You just fund positions 100% basically. And so your liquidation price, if you're going long, is basically zero, right? If the asset goes down to zero in price. So there's no liquidation that you have to worry about. As soon as you're borrowing money and taking leverage, then your liquidation price, because you're borrowing money, moves up, right? So if you have $1,000 to fund your position and you're using 2x leverage, then you can open a $2,000 position. Well, that means that your liquidation price is now half of the position size. If the position moves down 50%, then of course you've only got $1,000 to pay for losses. So a 50% downside moves wipes out your initial position. So a 50% downside move is actually, in relation to your underlying position, a 100% move. So it doubles the moves up and down. And of course, as you go up, if you have a 10x leverage, that essentially means that you've got $1,000 in, your position is $10,000, and so a 10% move on your open position to the downside, if you're going long, wipes you out. So there's ways to use leverage. The first one is simply just make your position size bigger. So you have $1,000, you use 3x leverage, that goes to $3,000. The problem is that, as you can see here, if you're using no leverage and you make a 30% loss on your $1,000, you just lose $300. But with leverage, if you're using 3x leverage, a 30% loss on your position is now a $900 loss because you've just got a larger position. So a 30% loss moves into a 90% loss. And of course, around 333, whatever, that would be your position completely wiped out. So when we're taking leverage, really the thing we need to know about is the leverage so large that a small move to the downside is going to wipe out our position? And so what we really need to know is, well, if we're taking a position, where is the price at which we think we want to get out at? Like, where is our stop loss, right? So you're taking a position here, and then you have, well, I think the price may get down to here. That's where my stop loss would be. So that's what I'm comfortable losing. Now, if your liquidation price, you're taking so much leverage that your liquidation price is here, you're using too much leverage. If your liquidation price is down here, then that's fine because it's below your own stop loss anyway, where you get out at a loss because the trade was wrong and you think, I just want to cut my loss here. So using leverage, we can easily work out this scenario, right? The other way to use leverage is actually not to just take bigger positions, but to just put less down in the trade and take a position size that you would have anyway, right? So with 3x leverage, we can still have our $1,000 position, but instead of putting $1,000 in, we only have to put 300 or so dollars in. So we can use less to fund our positions. Now that's pretty good if you have a portfolio anyway, because you may want to use those assets somewhere else. Like for example, in staking, or just put it in your wallet because you don't want as much on the exchange. So there's different ways to use leverage, and just making your position sizes larger is, obviously the riskiest way and the most amateurish way of doing it. Most professionals will use leverage sparingly, just to make things easier for them and the rest of their portfolio. The first type of position I'll show you is a long position. So when should we take long positions? Well, there are distinct phases in the Bitcoin cycle, and so we can go through that very quickly here. So 3 distinct phases of a Bitcoin cycle is expansion, contraction, and recovery. And each of these takes quite a long while. You can see that the expansions are usually around 12 to 18 months. Then we have the contraction phase, which is around 12 to 18 months. And then we have the recovery phase, which is around 12 to 18 months. Where should you be taking long positions? In the recovery phase, into the bull phase and the expansion phase. During drawdown phases, obviously you shouldn't be taking any long positions there. You're going to get wrecked. They're very distinct, these phases. What you can do is come into the crypto investor course. I'll link it below. We go through all of these phases all of the time. I have updated research of where we are in the macro and everything. You can check all the details in the crypto investor course and come and chat to me in there as well. We really need to know that when we're trading, right? But there are 3 distinct phases, and so long positions really are good to get into as the recovery phase comes into the bull market. Right? That's when you want to take long positions. You don't want to be taking long positions when the Bitcoin price is very, very overbought and it's near kind of all-time highs. That's a terrible time to be taking long positions, right? So recovery into bull market is really where you want to be taking long positions here, right? That's going to give you a better risk reward, and you're in the right phase of the market there. Now, during those, when do we take these positions? Well, we can take those positions on a drawdown potentially, or just when we feel like the market is consolidating and the risk reward is pretty good, right? So we can see that the price, does move up from these low levels during the recovery and expansion phases. So these are very good to kind of keep your eye on. So from here, we need to know, when do we take these positions? A drawdown of around 20% is very normal for Bitcoin during a recovery or a bull market. And so we can be looking out for those, right? You don't want to just take a long position randomly. You want to look at a potential drawdown, right? So these are previous bull markets, and you can see that in previous bull markets, the percentage drawdown is anywhere from 20 to 40%. And so if we get a drawdown of around 20%, then we're playing the odds here. This is the riskiest way to trade, but we're playing the odds that if a 20% drawdown comes in, that's a very decent drawdown for Bitcoin in a bull market. And so we can start entering positions there. You can ratchet in your positions. You can open one at 18%, 23%, 28%, whatever you want to do. We don't just have to take one position. But as we can see here, this data is not very relevant because Bitcoin was a different asset back here. But in modern times, we can see that during the early stages of the bull market, you get some big drawdowns. Now, this again was the pandemic, so a little bit of an outlier. This is a good one here where you can see drawdowns 20 to 30% are very normal. So if we know we're in a bull market and we're watching out for 20 to 30% drawdowns, that's where we can be active. Now, we may get stopped out and wrong on occasions, but a couple of bad trades is fine because with Bitcoin, if we catch a trade, then it can go up very well from there. And with a bit of leverage, we pay for our losses. So in a bull market, in a recovery or a bull market, 20 to 30% drawdowns is where we want to be looking, right? And so what we can see here over the recent recovery is that these drawdowns happen, right? So this was a 22% drawdown from the kind of the range high. So you get the high drawdown, right? So that's a 20% drawdown there. We had another high here. And if we get a drawdown, that was around 22%, right? And so we have a high here on a wick, and then we get a drawdown of around 20%. They're the times that you have to go in, right? So if you know you're in a bull market and you're getting drawdowns, they're really times that you kind of have to try and take positions. And it's not any more complex than that. Now, there are many ways to trade, chart patterns and everything like that. I can't go through that in this video. Crypto Course has many if you want to check them out. I've got some other free videos that I'll link below. So 20% drawdowns or so is, when you need to start taking positions if you want to go long. Bitcoin is extremely volatile and we may get in at the wrong price. And so we have to think about a stop loss level and our leverage that we're using. If the typical drawdown can be, let's say 20%, but it may go to 35% or 40%, then that is from our position a big loss, right? And so we have to make sure that our leverage isn't going to get stopped out there. We give our trade enough breathing room if we're taking leverage. We don't need to. So what we can say is if we enter a position, at this level, let's say this is a 20% drawdown and we're getting at 42,000. Well, it may fall another 20% from here, right? So let's say 8,000, let's say 32,000, right? To make it easy. So 32,000 would be around this level right here, right? So the 32,000 level. So that could definitely be somewhere it could get. We just don't know. So that's where we have to place our stop loss if we're thinking about percentage moves. So a stop loss, right? If we enter a position at 42, and let's make it easy to say it's 32, would be around here, this level. So we enter a position and then we give ourselves this whole entire space as a potential loss that we could get into before actually getting out of the trade at a loss. Then you have to give yourself a little bit of extra room. So as long as our liquidation price, if we're taking leverage, is below this, right, this level here, then we're good. And we can go into the trade with an amount of leverage that we want. So that's how much price I would give myself if I'm taking a long is, it could go down here on a normal drawdown. So we get in at this level, we get out at this level or around this, and make sure our liquidation is below that so we don't get liquidated before our own stop loss. Now that we know a potential entry price and a stop loss price, we can determine how much we can trade depending on how much risk we want to take. So most traders will use their portfolio size and say, I only want to risk, 1 to 5% of my portfolio size in each trade. Well, how do you work that out? Well, you need to work out how much you can lose in this trade and then how many units of Bitcoin you can trade. So we know that our entry is, let's call it 42, and our stop loss is 32. That would be a 25% drawdown. So you go to a position size calculator. I'll link this one below. Trading Bitcoin here. Open price is 42. We would have our own stop loss price at 32. Our account balance is 10,000. We want to risk 2%. We know that we can trade 0.02 units of a BTC. So we know that if we open this with this trade size, based on the open and a potential stop loss, if we trade out, we would lose $200 on that trade. Right, so 0.02. So you now know exactly how large you can go in. So that would be if you have a $10,000 position or a trading balance for your active trading balance, and you want to risk 2% of it. You can obviously make decisions about how much you want to risk per trade. But from here as well, I know that I can use around 3x leverage, no problem, because this drawdown would be 25%. And if I'm using 3x leverage, I get liquidated at around 33%, which is away from the stop loss price that I set myself. Now we can open a sample long position and use all of the parameters that we want. So we know that a 2% loss for our sample portfolio would be 0.02 BTC, 0.02. Order by quantity, because that's the quantity of Bitcoin that we're trading. So 0.02 BTC. What we can see is that that would be a trade value of around $854. But the cost to us is $427. So that's the cost, the amount of assets and collateral that we have to put down to fund the position, because I'm using 2x leverage. If I change the leverage to 10x, what you can see is that the value of the order doesn't change, but the only thing that changes is the cost to us because we're using more leverage. So the leverage is coming from the fact that we have the same position size, value, market value of the trade, we're putting less in. And so you can see how the liquidation will move up in relation to our trade because we have less money to fund a potential loss. So that's how you get the losses and liquidations moving up. So let's move that back to 2x. I'll just show you as an example for this trade and press confirm. Now what I want to do is change the quantity and just order by value. This means I can choose the value of my trade in the market. So I'm just going to open a $50 trade here with 2x leverage, which means 2x on my collateral. So I should be funding half of this position. $25 out of 50 is half. So that's a 2x on my cost. 25 times 2 is 50. So we can just open this position. Now, when opening a position, you can take take profit and stop loss orders in, which is this. Take profit, if you're taking a long position, a take profit is a sell order above your position where you want to trade for a profit. But really more importantly is a stop loss. As we've seen, our stop loss was 32K. So that's where you want our stop loss. I know that if I'm taking 2x leverage, I can have a 50% loss, which is way below my 25% loss from my stop loss. So you can enter this when taking the position, or you can edit it after. So I'm just going to open my long here with a market order. So open long, it's going to show me those details. And then down here, the long position is opened. From here, we can edit our position, add collateral, take it away, close it, and edit all of the other orders. So I have the position here. You can see that the P&L right up here on the chart is there. You can see my entry position and how the trade is doing. Down here, you can see I've got the position open. And we have the unrealized P&L and the realized P&L. Unrealized is how is the trade going and what you've got left in the trade. Realized P&L is if you've taken partial profits or you've reduced the position size. So if you're in a big profit, you want to take 25% of the trade out and clip it out, then you can do that, and that will be a realized either profit or loss. And so the way we do that is going over to close, and you can close by either a limit or a market order. Just show you market order here. You can close 25% of the trade. That will reduce your position size by essentially, because we're long, it will take a short position, and our net position now is, long, but 25% less of what we had. So you can confirm that if you want. And then we can edit the take profit and stop loss orders here as well. So we can click add. And what you can see here is we can choose a price. Now for me, I know that the stop loss was 32,000. So we can do that. And that's a 50% loss. We worked that out already. It was around a 50% loss of where we were. So that's well within our liquidation. And you can change this on the slider, right? So whatever that is, right? You can just change the percentage loss rather than choosing a price. So you can work that out for you. So what we can do here is let's put in this stop loss order, and we'll press confirm like this. And what we actually have now is a completely separate order. So you can see the stop loss order is now on our screen. So we know that if the price of our order, which is here, tracks down to this price, which you can just see on the side, it's this red dot here, that is our liquidation, or that is our stop loss price, and that is a current order. The reason why it's a current order, TPSL, is because we haven't traded it yet. It's an open order. It's an order that says if the price gets down here, trade out of my position. So it's known as a trigger order because the order triggers at that price, and then it will be a sell order to sell out our long position at a loss. So because the price isn't there now, it's currently working for us and it's live. You can cancel that out right here if you want, and that takes away the cancelled order. If you cancel the position entirely, this current order will delete as well because it is linked to your open position. So let's cancel out the stop loss like this. You can cancel that, and then you can put in another stop loss if you want by going to your position and just adding in another stop loss wherever you want it to be. If we're finished with the position and we want to close it manually, we can do that. So we just come to the close by again, close by market order. We're going to close the entire order, so 100%, press confirm, and then the order is out and we have no live orders in the market. Now let's look at using futures to hedge positions or to take advantage of arbitrages in the market. We can carry out what's known as a funding arbitrage or a yield rate arbitrage. And so what we're doing here is trying to buy an asset that pays us a yield because we want that yield, but we don't want to take a naked position in the asset meaning we don't just want to buy the asset because we don't want price exposure to the asset. We just want the yield that it gives us. This is known as a delta neutral trade or delta neutral yield arbitrage, funding arbitrage. You're trying to get the yield, but you're trying to reduce your position size, your price exposure to at or near zero. So we can do this with assets that pay us a yield, for example, Ethereum. So let's look at that. We can go and buy Ethereum in the spot market and go long Ethereum, right? And so we'll do that in our spot account on Bybit. Now we don't want ETH because ETH doesn't pay a yield. What we want is staked ETH because that pays us the staking rewards. So ST-ETH is available on Bybit. You can buy ST-ETH or staked ETH. And this pays us the staking rewards, which currently are around 3.5%. So if we have that in our account, we have price exposure to ETH, and we have this staking reward, which is 3.5%. So how can we use futures to hedge our long position? Well, we can take a long in the staked ETH, and we can use that as collateral to take a short position in the futures market on ETH, because staked ETH and ETH are the same price always. And the reason you get the 3.5% yield is that the amount of staked ETH you had rises over time. So you actually get more tokens in your account over time to represent the 3.5% or whatever the yield is over that 12-month period. So we're long staked ETH, one staked ETH. We can go short in the futures market, one ETH, using our staked ETH as collateral. And so we're long one ETH and we're short one ETH. And so our position is delta neutral. We're long one ETH and short one ETH. So if the price goes up or down, it doesn't matter because both positions will either gain or lose the exact same amount. But we are arbitraging the yield, 3.5%. And so that is a yield rate arbitrage or a funding arbitrage. So the first thing is we have the 3.5% from staked ETH that we're getting in our account. The other thing that we can get, like I said before, is that when crypto futures trade, there is a funding. And, for most of the time, funding is positive, which means that longs pay shorts. So if we're taking a short position in the futures market, we're earning the funding as well. You can see what the funding is. You can see the funding rate is 0.01%, and it changes hands every 8 hours. You can go to derivatives info, derivatives data, and actual funding rate. You should be able to see that. So that's right here. You can see what the actual funding rate is going to be, or what it's predicted to be every 8 hours. And then if you go to something like CoinGlass, you can actually see funding rates around different assets. So you can see the 30-day funding rate for Ethereum is around 0.9%, right? So let's just call it 10 to 12% a year, something like that, that you would be getting if you're a short seller right now. So if you've got a short position, you're receiving that funding from longs, and that would be, call it a percent, a month, something like that. So what we would do here is buy some staked ETH in our spot account. What I'm going to do is transfer that over. So from our funding to our unified trading, we need some staked ETH. So we can put one ETH over, press confirm, and then we're using that as collateral. Now, as you can see, the amount of collateral in my account has gone up. So I now have collateral to trade with. I've traded one ETH over, and I can trade a short position. So we're going to have an order by quantity, press confirm, one ETH we're going to put in here. And let's do 2x leverage. So press confirm, and then you can sell short. Now what that means is from here, we have a huge price appreciation, right, before we can get stopped out. So what do we need to think about in this trade? The first one is, if we get stopped out, wherever it may be, that's not the end of the world, because our long ETH position has obviously gone up in value, right? So this short position coming out isn't like the end of the world, but you pay some extra fees, you pay a liquidation fee, so you'd rather not do it, right? Especially if you're yield rate arbitraging, because yield rate arbitrage is, maybe you can make 5, 8, 10%, something like that, right? So any kind of percent that you're trading out from liquidations is something you don't want. So you have to keep an eye on that. But if the price is going up, it means your long position is gaining. So we don't want to get liquidated because we want to manage the position properly. So we have to really manage our leverage here. And if we're using tons of leverage, then our liquidation is very close and we could get stopped out, and that's just not a good trade, right? So we need to manage our leverage. But of course, if you use leverage intelligently, you can keep more of the long side. So instead of putting 1 ETH in long and then 1 ETH short, you can maybe have a 2x leverage position on your collateral, which means you can keep more on the long side. And so you can have a kind of a bigger amount, right? You can buy more ETH because you don't have to fund the futures position 100%. So you only choose 50% collateral to cost, so you can actually have money left over to buy more Ethereum and stake it and get a little bit out of that. Now, obviously this works with much bigger amounts. It starts to really add up. So you're getting funding rate arbitrage, yield arbitrage here. So that is one way to use futures to actually hedge positions and take less risk. Where you can really ratchet up this strategy as well is looking around crypto if you use blockchains themselves and see where yield is highest. So as an example here, on Pendle, which is a yield market, so the market for yield, people actually buy yield from you and you can fix yield over certain amounts of time. And so you can see here for right now, some ETH staking derivatives are paying very, very high yield. So what people are doing right here is saying, I think that these assets right here are going to yield me something in the future. Now, we won't get into the reasons why, but what's happening now is essentially an investment opportunity, an airdrop that's happening, which may give people obviously fresh tokens, which may be a very good amount of tokens, and so people are paying for the right to have the benefits of the Ethereum token that's being staked. And so to cut long story short, they're paying you an annualized yield of 30% to get the rewards from this token. And this is an ETH staking derivative, so it's kind of 1-for-1 for ETH. So what they're paying you for the next 142 days is an annualized rate of 33%. You could fix that right now. So that's a fixed yield that you get. They're paying you that as a fixed yield. So you know that for 142 days, which is the time of the trade, right, until this expires, you'll be getting a 33% annualized rate. So you can lock that in. You get a fixed yield for about half a year of a 30% APY. So you know what you're getting from that fixed yield. So instead of just having that and having the price exposure to ETH, you could say, well, that's a very good yield. So what I'm going to do is I'm going to get 1 ETH in here and I'm going to get that fixed yield, but I'm also going to go back and hedge my position by taking a short position on the future side as well. So now, instead of just getting the rate of staked ETH, which is 3.5%, you're using other yield markets or other short-term opportunities that are around, because there are airdrops in crypto, there are incentivizations from different protocols that increase yields for different reasons. And so people are willing to pay for the right to have those things that accrue to your token. So if you find somewhere where you've got this yield that's very high, you can go into that, but you can also hedge out your price exposure to that underlying asset. So that is how crypto can actually hedge out positions, and you can make much better yields without having to take as much risk. Another way we can take advantage of the futures market is to trade a pair of assets, so not a dollar here. So this is known as a pairs trade, or trading the delta or the price difference between two crypto assets. So crypto moves in very distinct phases, and we have the bear market, a kind of recovery or malaise, and then an expansion. And Bitcoin moves differently to altcoins in these phases. So we can see how that works here. There are two distinct phases where you have phase one, where Bitcoin recovers in value and starts to move upwards. During that phase, that first phase, altcoins tend not really to do much. They're still kind of being distributed out, and there's a lot of selling pressure on those altcoins. And so Bitcoin moves up in value, but altcoins tend to move a little bit sideways here. And so the delta, or the price difference between the altcoin market and crypto and Bitcoin gets wider as, Bitcoin moves up and the altcoin market kind of stays where it is. During phase 2, which is real bull market, you tend to get big outperformance by altcoins. So Bitcoin is still moving up a lot in price, but it's just that the altcoin market is recovering faster and closing the delta between altcoins and Bitcoin. Now, during the downturn, as you can see here, this phase, right, which is a bear market, Bitcoin loses value and altcoins lose value faster. So that delta then gets bigger again. And so the phase 1 happens, Bitcoin starts to move up, altcoin market moves sideways, delta increases. Phase 2, delta gets smaller. And then in the drawdown phase, you see that delta increasing again. So what we can do is trade the delta. We don't trade just using dollars to go long or short, which we can do, but we're actually trading the price difference of Bitcoin versus altcoins. And so because these phases are pretty distinct, we can try and earn extra income from trading this without having to let go of our assets and just take long and short positions. So what we can do, because we have a unified trading account, I'm going to go to Solana. And so Solana is an altcoin that's performing very well right now. And in a bear market, most altcoins tend to bleed value. That delta gets bigger. So we can wait for that bear market to happen, right? It's very obvious when it happens. Bitcoin tops out, starts to come down. And so I don't want to let go of my BTC. I don't want to trade short BTC. I don't ever trade short BTC. It's an asset. I want to hold it, but I can potentially try and use some of my assets to earn a little bit extra around the edges of my portfolio. So yeah, Bitcoin may be coming down in value, but I can try and take short position of the altcoins, and I can make some profits on those trades, which pays a little bit of the money I'm losing from Bitcoin coming down in value in a bear market. So what we can do is transfer over some assets. So from my funding account, I can transfer over some BTC. So like this, confirm that. So now I'm using BTC as collateral. Now, of course, this is more risky if you're trading BTC and just longing or going short BTC. But because you're trading a delta here, as long as you're in the right phase, we have a pretty good risk-reward ratio of getting this trade right, because we've seen how these move. So even though Bitcoin may be losing a bit of value or maybe going sideways, we know that the risk-reward here is pretty good, that altcoins are going to bleed against it. So even if BTC is losing collateral value, our trade, if the altcoin is falling faster, is gaining an unrealized P&L. And so because we have a P&L and what should be a profit, that's actually extra equity in our account. And so even though the Bitcoin is coming down in value, we're gaining in the trade. And so the trade has equity, and so our margin isn't an issue. The downside of doing this is that if an altcoin actually outperforms Bitcoin in a bear market, which is possible, and that is a risk, which is why we only actively trade with a small part of the portfolio. But the risk reward is really, really good over longer time frames. So again, not just taking a speculation trade, long or short, which is the highest risk thing you can do, but trying to earn extra yield and profits trading around the edges of your portfolio whilst keeping your assets. I'll leave the Bybit deposit bonus link down in the description. The Crypto Investor course has way more videos like this. I'll leave some free videos down there as well. I'm James with MyZG. Cheers for watching, and I'll see you in the next one.